we've titled this the lull before the storm. We're in some topping phase. It could go on for months more. We don't know how long. At some point, things will give. As David said, when bubbles burst, they go straight down, and it's very ugly. But the only problem is you don't know when they're going to burst. Now, we look like we might be in the beginning of some bubbles bursting. So we'll see about that in a second. The contents of this presentation are not intended as a recommendation to buy or sell any security, and are for educational purposes only. Okay, that's our disclaimer. And the New York Investing Meetup, once again, is not affiliated with New York Life. Okay, here's so we have some pictures. U.S. recovery has hit some rough patches. Here's the economy right here. It's a stock market, you know, it's like just sort of just barely balanced. What could go wrong? That's the picture of the stock market there. And then is the political news. This is Donald Trump announced this. This is the first dog he's already selected who's going to be the mascot for the White House here. That's his dog. Most people don't know this. Yeah. So I found that picture on the internet. I've tweeted it everywhere. It's the most hysterical thing I've ever seen. Okay, so hair's better than Donald Trump's.
That's funny.
Yeah. So what do you want? So Q1 GDP, in case you didn't hear about it, came in at minus 7.7%. That is very bad. That's a negative GDP. It's there's not only growth, there's contraction. First quarter last year, the same thing happened. GDP was actually minus 2.1% in the end. So there seems to be some trend happening. So a healthy economy does not have negative GDP ever. So could we be starting a recession now or later this year? Yeah, we could. We don't know. It didn't happen last year, but then again, they really phonied up the numbers. And we discussed that as it happened in one. Meanwhile, though, and because the GDP became bad, there was lots of talk that they didn't seasonally adjust the numbers enough, and they should, what's being called devil seasonally adjust them. And it's like, you know, we didn't get the numbers we want, we should like fix them so we get the numbers we want. The government has been doing this for years. They have changed how they did GDP about 2 years ago or thereabouts. They've changed it previously. The Europeans changed it more than once. In fact, in Europe, Britain had 3 recessions, France had 2. They said, oh, we'll recalculate how we do GDP. Suddenly there were only 2 recessions in Britain and 1 in France. So it's not like anything got any better. They simply fixed the numbers and not the economy. And governments have a tendency to do this. This is totally out of control at this moment. So you can't believe any of the numbers. You should just consider they're all fair. Meanwhile, the U.S. is claiming we had 280,000 jobs created in May. I highly doubt this, but that's what they're saying. At the same time, not in labor force. Those are people who are left the labor force, they're not looking for a job. That hit a record number in April, and then went down slightly in May. Now, if you're not in the labor force, you're not counted as unemployed. So this makes the unemployment numbers look better. Now, however, not an increasing number of people not in the labor force indicates a structurally weak economy. So there's other evidence that things are really bad despite this 280,000 number. Okay, so retail sales are up 1.2%. That looks pretty good. These are not adjusted for inflation, however. So if there's like actually a lot of inflation and the government's lying and say there isn't, then they're not so good. And the biggest increase in retail sales was gas, and that's because gas prices went up, not because people were using a lot more gas. So that's a pure inflation indicator. So, I mean, this looks good on the surface, but it's not really so good. Industrial production has been down since November, and there's actually been articles in MW's Market Watch, so I cited the source, that say U.S. manufacturing is technically in a recession. So part of the economy is not doing really well. And, you know, manufacturing is smaller than it used to be, and then just like our, you know, throwaway government political number, there was a study by the CPO, that's a Congressional Budget Office, which determines how much money the U.S. spends and why it's spending it, that just came out a couple of days ago, and it said Obamacare will cost $50,000 per taxpayer money per enrollee. Now, you could have bought insurance on the open market for every enrollee for a lot less than $50,000. So this is like incredibly economically wasteful and inefficient. which everyone has said from the beginning, basically, except for the people that supported Obama. So, and that's just going to get worse and worse and worse, too. Decline in the U.S. labor force. A lot of people claim, including the BLS, that's the Bureau of Labor Statistics, they say, oh, it's baby boomers retiring, and that's why the labor force is declining. Now, here is the multi-year graph going back to 1978. You see the labor force actually peaked in 2000 and has been declining since then. Now, one baby boomer retired in 2000 or prior to that. And baby boomers basically just began retiring around 2010 for the first time. So there was a 10-year drop before even one baby boomer declined. So this puts this claim to a complete lie immediately. And you can also analyze the labor force based on age categories, and you see even people 18 to 35, there's been a drop. People have dropped out. 35 to 54, they've dropped out. It's not just older people. So this is a serious structural weakness. Now, GDP, this chart's hard to read. This is long-term GDP since World War II. So it goes back many years, like 70 years. And you see the peaks in GDP were really big till about the 70s. And then since then, they've declined. So the U.S. is actually, the economy is getting weaker. And you see in the latest recovery, first it was a Great Recession. Now, the recovery has been very weak, even though the government is manipulating the numbers to make them look better. They're still worse than previous numbers. And if they didn't manipulate them, if they were realistic, they'd probably almost all be negative. This is just interesting tidbit, U.S. labor productivity. It's actually been negative for the last year or so, or a couple of years. This is also a very bad thing. Indicates our economy is like very inefficient. Money is being spent and return is not being gotten for that money. So this tells you something's wrong. What exactly is wrong, you have to look and find out. And we could spend many meetings just discussing that. We always do this. This is inflation. And I have great expertise in inflation. Governments have always lied about the inflation rate throughout history. Nothing is different this time. They say it's easy to fix the numbers than to fix the problem, so they just fix the numbers. And Shadow Stats is, you can go to this website, it's free. They have paid services also. And you can find the blue line is simply what would inflation be today if it was calculated as it was in the 1970s. The red is what the government's reporting. Notice that starting around early 80s, those two lines started to diverge. Now, and that's when they started adjusting the inflation numbers. And in the early 80s, they took out house prices and put in owner's equivalent rent. And that has reduced the inflation from housing by about 50% over time. And that's why they did it, of course. And then in the 90s, there were a lot of reforms in the Clinton era that reduced it, that were absurd. They're totally absurd. Economists will tell you with a straight face, oh, this is how it works, it makes a lot of sense. And they're completely illogical, like an 8-year-old could actually figure out they're illogical. So, but if you want to compare inflation now to the 70s, you must look at this blue line, because they were all calculated the same way. You can't, otherwise you are comparing apples to oranges. That red line, even though it's red, think of it as orange. You cannot compare that line to the 70s numbers. So our inflation has been actually in 2008, it was almost as high as the peak in the 1970s, the real inflation rate. And even now it's fairly high with the government saying there's no inflation, inflation's zero, inflation's negative, and CPI is like slightly negative. You go shopping, you look at prices, you see everything goes up. So you should believe your eyes and not what the government's telling you. We've done this fiscal state of the U.S. It's basically been very little changes since the last time. We started this in 2008 when the national debt was just over $9 trillion. Notice it's 18.3. It is double from when we started speaking about it in 2008. So, if you know anything about doubling, what happens if you keep doubling numbers, you quickly get to infinity. So, it only took 7 years for this number to double. This is like an outrageous, it's classic. If you have any computer science education, you know this instantly. There's the famous chessboard problem in math, where you like you put 1 grain of wheat and 2 grains of wheat and 4 and then 8, and suddenly the number's like massive. So not much is changing. Things are like pretty bad, but they're not getting worse at the moment. And there's one point we just have to make. Historically, average interest rates, and those are Fed funds around 5%, 6%, which is the average over 100 years or more than 100 years, would bankrupt the U.S. So if we got to this level again, the U.S. would be, and almost every major country on earth would be bankrupt too. So global news, the big story is Greece. You must pay attention to this. Greece is in danger of defaulting. It basically has, it's de facto defaulted, just not de jure, which means by law. De facto means like in reality. So there's a big deadline, June 30th. Maybe that will be papered over. The market is hopeful it will be papered over and somehow fixed. Even if that does happen, Greece still has more debts in July and August and September. It just goes on and on and on. They have no money. Their economy's a mess. And eventually they're going to have to default. You know, if it doesn't happen now, it will happen at some point. And things are getting very testy and very ugly. So this could be, if this happens, and it will happen at some point, this can really rock the markets. Now what will happen, the central banks will come in and pump huge amounts of money in the market if the stock market collapses, and to try and fix it. And that will fix the problem temporarily, not forever though. So we'll wait, that may be happening this summer. So, you know, some interesting fireworks may start to appear. Meanwhile, there's an interesting number out of China, and there's been a decline in trade, their trade numbers. And exports went down, which is not good for China, but imports really, really went down. So China's still okay. I mean, you always want your exports to be greater than your imports, which has not happened in the United States since the early 70s, by the way. So this is disturbing and indicates there's some problem in the Chinese economy. Also, this is the second point, this petro yuan is born. Morgan Stanley said, oh, oil is settled in dollars, which is true everywhere in the world. Russia and China are now settling it amongst themselves in yuan.
Gold.
Yuan. But there's actually a petro yuan now. And it's a long story. China actually backed the ruble and saved the ruble of a couple. You won't
They've
hear
been
that.
buying a lot of gold.
You won't hear. Oh, Russia's buying.
And so is China.
Oh yeah, but that's not official. They're not admitting to it. They are doing it. Yes. This is an aside. This is one of the many lies. We live in a world where there's nothing but lies and lies and lies, or things go wrong. Bursting bubble. This is something. Oh, QE. This is an interesting point. The ECB is doing QE, and that's what's held the markets up in the world. Made the DAX. You saw the DAX go up in David's chart. We're going to see it again in a minute. They front-loaded that this spring because they said, well, the bond market is very dead, weak in the summer, so it's hard to buy bonds. We'll buy all our bonds in advance, what we're planning on doing in the summer. So there's like actually no stimulus support for the market in the summer from the European central banks, and that's been holding up the markets globally. So there could be a decline in the next couple of months because of this lack of support. So watch for that too. Bursting bubble, there was a massive sell-off in German bonds. This cannot be understated how serious this is. And we're going to see the chart in 1 second. I'll show you what it is. And I asked Morgan Stanley, there was a BP, British Petroleum Statistical Review of the World Energy came out this week, a couple of days ago. And they actually said that oil production in 2014 was much less than had been reported. Now, what has been in the papers and financial press over and over again is, oh, production is out of control, production's too much, there's way, way too much. Then the yearly statistical survey comes out and said, no, it's not nearly as big as you've been told. So, like, this is like suddenly, and the oil market just skyrocketed on this. It actually sold off, which makes no sense, which tells you how manipulated it is. But, I mean, that's going to hold up the market, too. Okay, here's how you tell if Greece is default. This is like the cartoon. Now, I really like that. The important thing about this, notice what type of money he's asking to insert. Not euros. So this is telling you this cartoonist thought they're going to default. I mean, I think, I don't know. I have no opinion that they're going to go back and forth, back and forth. In reality, it has defaulted long ago. So it's just, are they going to admit it? And here's a German Bund seller. Bund is German for bond, so they call their bonds Bund. it's just say bond with a German accent, you got it. So notice at the bottom was in April, and the interest rate on the 10-year bond was about 0.07%, 7 basis points, almost zero. Now in Switzerland, it actually was zero, below zero, it was negative. So almost zero, and that's ridiculous. That rate is totally ridiculous. And like in the last 2 months, it actually got over 1%. That's 0.9. It actually got over 1%. And this is the interest rate. Now, for the interest rate to go up like this, it means the price of the bond has to sell down tremendously. So this is like sudden and sharp. It's a typical bubble bursting behavior. Market summary, U.S. stocks moving sideways. We're in a topping action. European stocks have started selling off, which David has mentioned. The massive sell-off in bonds, it wasn't just in boons. It's happened everywhere in the world, actually. The boons were the worst case in Germany. And in March, we actually mentioned this previously. In March, there was a big drop in long bond positions by big money. We actually said this 2 months ago, at least. And then this is before this massive sell-off really got underway. So we warned you about this. NASDAQ has touched an all-time high. In fact, it did it today. It was the intraday high, and it was within 1 point before today, or half, or 3/4 of a point. So it was not shocking. The dollar seems to have peaked. Of course, if Greece goes under and the euro starts to sell off, the dollar could go back up. That would just be a safe haven move. The only cheap assets in the markets anywhere are commodities. They are extremely underpriced, just as stocks and bonds are extremely overpriced. So as far as I'm concerned, oil has a confirmed double bottom. I'm not quite as negative as David is. And I'm, approximately where Morgan Dow is. Dow Industrials, everything's fine. That red line is the top David predicted in late December. Notice the market has not gone more than an iota higher. So, that's sort of a de facto top if we don't go any higher. And notice the descending line, that's the RSI, that it's lost strength for 2 years. There's a weekly chart, 2 years. I mean, eventually this is going to go, and it's going to be ugly when it goes. So far, everything's okay, though. Until it breaks, if you see that arrow, that red line, until it breaks that red line and stays under it, and that's the 325-day moving average, everything is fine. And it has to stay under it, not just break it. Because when you see the FTSE actually did break that line 3 times about 6 months ago, 8 months ago, and then it suddenly popped back up because the ECB printed lots of money. Here's the volume on the Dow for the entire rally, for the last 6 years. That volume has been in decline. This is not appropriate, it should be rising. And we've mentioned this, and we said these type of anomalies can appear. And when they do, you always have to pay the piper at some time. You really, really have to pay when it's going this long. The S&P looks very much like the Dow. NASDAQ actually looks a little better. It's still it rose after they did. Still, it's like sort of looking a little weakish, although it might go a little longer. Here's the 25-year chart on NASDAQ. You see the previous top 15 years ago, the top now. That's called that's resistance, and it's major resistance because it's a very long-term top. And that's the bubble in NASDAQ, that circle, that's the RSI. It went above 80, it never should do that. It did it multiple times. That was the bubble formation. So that was a warning, and then it collapsed. We're not such a big bubble right now, but things are sort of normal. The NASDAQ, not this, it was the center of the bubble in 2000. It is not the center of the bubble anymore. And it doesn't mean it can't lose half its value or more. It just will be collateral damage to some other bubbles collapsing, like all the bond bubbles in the world. And there are a number of stock bubbles in the world too, like China. The Russell has actually been stronger than anything else, but notice it has that 2-year declining pattern also, which means when it goes, it's really going to go badly too. Here's the US dollar. The peak seems to have happened in March, April. That is in a bubble also. That pattern, notice it's above 80, and it's above 80 over a many-month period. And we also see that black line on the bottom. That went to about 65, 68. That should never go above 40. That's also bubble behavior. So that doesn't mean the dollar can't go back to 100 and make a double top or even high if the euro collapses. It depends on events. But right now the dollar is actually weakening and is heading down. Here's the DAX. It was down at least 10%, so that's the definition of a correction. So this is not a real bubble. It's like it went to 80, it's slightly above. It's really overextended and needs to go down. But it's not like China, which we'll see in a few seconds. Here's the euro. The euro is the mirror image of the dollar. This is the dollar's in a positive bubble. The euro was in like a negative bubble. So, a positive bubble you have to collapse and go down. A negative one you have to sort of skyrocket and go up. So this will be the opposite behavior when something happens. Here's the Swiss franc. This is tied to the euro. It was untied, but really tied back. Swiss franc is actually a good currency and worth something, so you should pay attention to it. Here's the FTSE. Notice I said there were 3 violations of that red line. Here's the 3 violations. This meant this market was about to collapse, but somehow it magically recovered, and that magically recovered because the European Central Bank started printing lots of money. So that drove every market in the world back up. Now that's going to run out by next spring at the latest. But even though they're doing this, the German market still can't go up. And the UK market's going down too, and all the markets, even with the money printing, even with massive money printing, the markets are going down. All stimulus eventually stops working. And the correct analogy for central bank money printing stimulus is heroin addiction, which I assume no one in this room has ever participated in. Nor have I, I've just read it. Now, what happens, you take heroin, you feel really, really good, and you feel great, and everything's terrific, and you take it, and you don't, the same amount, and then you don't feel, you feel better, but not so great, and eventually you don't feel anything. And if you don't take it, you really, really, really feel bad. So you become desperate to keep taking that drug to feel normal. So the market adjusts to all of that stimulus. And it needs that stimulus just to be, first it goes up and up and up, then eventually it needs all that stimulus just to be normal, just to go sideways. And that stimulus is taken away. It's like taking a heroin addict's heroin away. They really feel horrible and they turn green. And the market starts collapsing. And this is why the Fed cannot raise rates 1/4%. I mean, rates are 0. I mean, we're supposed to be in an economic recovery, and they can't risk a 1/4%. Who's not going to borrow 1/4%? Who would borrow at 0? I mean, this is insane. This is why they won't even risk that 1/4%, because it's basically like taking the heroin away from the addict. I mean, even that can make the market turn a little green. Well, actually, turn very red. Red is the correct color. So the FTSE was about to collapse, but the ECB saved it. Now it's turning down again. The Nikkei has gone up simply because this is Japan, because they've debased their currency. So I mean, you have to know the reason the market's going up. It is not money printing. It's currency debasement is effectively the same thing. Doing it in another way. This is very bubblish looking. If you look at that red circle, the RSI was above 80 for quite a while. This is all pure market manipulation on the Japanese authorities. It will collapse and be ugly one day. Here is the Nikkei versus the yen as the currency. That red line is 0, neutral. Notice as the currency was being pushed down, the market went up. Now you basically got about 3 times market up movement for 1% decline in currency. So it's actually a good investment. If it was 1-to-1, you wouldn't make any money really if you started with dollars. So this is actually worth investing, but when it goes down, it's going to go back to that neutral line at some point. And here's the yen. You see it going down and down and down. Now the Japanese have actually made a remark saying they can't drive their currency down. Like this week, I think, someone in the finance ministry said, we can't drive it down anymore. It's already been driven down too much. So you should assume this might be at the end point. It's very dangerous to have a currency that's too low or too high. Either one is dangerous, for different reasons, of course. It's like temperature. If you're comfortable at 70, you're not going to be comfortable 120 or 20. You need to be in this neutral ground. Currency is the same way. If you get too far from that midpoint, the economy becomes uncomfortable for different reasons. So here's the Shanghai Composite. This is a Chinese market. This is a bubble. If you we're teaching a class and we wanted to show what's a bubble, this would be one of the perfect examples of all time. It's live. You're seeing this bubble live right in front of your eyes. It's happening. And you notice the market was dead. Suddenly it started shooting up. You see that circle. It's way above 80 for months. That's totally bubble looking. The market has zoomed up from 2,000 to 5,000 in less than a year. So that's a huge, way up 100% increase. That's way, way too fast for a market. You see that black line is around 60. It should never be above 40. That's also a bubble. And it's not just for one moment. It's like for months and months this is happening. This bubble could go higher. I'm not sure it's over. And I did sort of just a simple counting technique. And it looks like it could last at least to August, September sometime. And if it gets to 5,000, way above 5,000 to 6,000, you can say, oh, okay. I don't think it's quite over yet. I think there's still more push. And when it goes, it's really, really going to be over. And this already happened in China in 2006. So, I mean, they had a bubble less than 10 years ago. They make another bubble. And this is our financial policy throughout the world right now. Just you have a bubble, the way you solve it, make another bubble. You see India is selling off. India is not in a bubble. It's just been in a rally for a long, long, long time. It's decaying like other emerging markets. As I said, emerging markets in general throughout the world is selling off. Only China is the exception. Russia already had a big sell-off. It could make a double bottom. I would not be surprised. Cheap oil prices have really hurt it, and they're going to continue to hurt it. So if Russia has a collapse, it would probably be an excellent buy. The Bovespa in Brazil, these two lines, it's in a multi-year sideways trading pattern. And you can see it's like keeps going up and down. Now it's selling off in the last couple of months like every other emerging market. And if there's a big sell-off, it'll probably hit that bottom red line. Now if it breaks that bottom red line and goes below it, then that's a serious sell-off. I tell you something. As long as it's in that range though, nothing unusual has happened. This is oil. This chart is screwed up. And you see that little dot up there, that's a fake trade. It probably was a real trade, like one trade. And there's charting, some charting services correct that. Big Charts does not, but that's why it's free. So this is screwed up the chart, so we really can't say. You can see the double bottom, and you can see you see that line on the very bottom, that black line went to about 60 something, 65 at least. That should not go above 40, I want to remind you. So this was in a negative bubble. You see the RSI actually went way below 20. So when this is going to have a huge rally at some point to make up for the huge sell-off. So we don't know when that's going to happen, but it will happen. Natural gas, maybe this has made a double bottom. It's been down for many years. We're going to watch this closely. And as Morgan said, if there's a hurricane in Katrina hit in 2005, oil actually peaked the day it made landfall, and that was at $70 a barrel. But natural gas actually went up for the following 2.5 months into November, and it skyrocketed. Oil went up a few dollars. Natural gas went up like 3 or 4 times. So a hurricane can be really push on natural gas prices. Coffee, we're waiting for the bottom. My guess is we have to hit 20. We got so close to it. Coffee, Brazil has a frost every 10 years around this time, and every 20 years that frost is really bad. And we are at that 20 years either this year or next year. So, and when that happens, the price of coffee skyrockets. So, watch out for this. It's winter in Brazil now. In 3 days, it's winter in Brazil. So keep that in mind. We have to see what happens. Australian dollar goes with gold. It's trying to make a bottom, just like gold is trying to make a bottom. In fact, if you cannot buy gold because you're like stranded in Australia or something, you could buy the Australian dollar as a substitute. And it won't go up or down the same amount, but you have to do something to magnify the trade a little. But it does move with gold. So like if the government suddenly banned gold, you can't buy gold. Well, you could buy the Australian dollar and get around it. You didn't hear that from me, remember? Although I've written it in my books. So gold is making a flat bottom, just like David said. This could go on forever. We don't know where it's going to end. Miners, same picture. Silver, same picture. Copper is like, doesn't look healthy. Copper tells you what's going on in the global manufacturing economy. And that's been on a downtrend for 3 years. So the global manufacturing economy has been on a downtrend for at least 3 years. And whether this is bottomed, I'm not so sure. It may not have bottomed yet. There may be worse things to come. 30-year Treasury bills. This is interest rates, not the price. Notice the interest rates, even in the U.S. on Treasuries, have been going up. This is the 30-year. They went up from 22 means 2.2%. 32, 3.2%. It's gone up a percent in the last 4 months. That's quite a bit when you start over at 2.2. And 10-year, same thing. It's going from 1.6 to 2.4. That's 0.8%. This is we're seeing that same bond sell-off in the United States. It's happening everywhere in the world, and bonds are the biggest bubble everywhere now. Not so much in the United States. I mean, Europe is much worse. Japan is much worse. So, but you know, this is when this bubble goes, it's going to be quite ugly. The bond market, by the way, is much bigger than the stock market. So if you say that that's, you know, that bubble burst, well, that really affects, you know, lots of things. Okay, any questions? We have to go, so. No questions? Everyone knows all? Okay, well then that's it. Thank you very much.